Hello learners and viewers, welcome to this session. Today's topic is Plural Financial Inclusion. The learners who have enrolled in Master's Program in Gender and Development Studies, specifically if they have chosen elective course in the second year, that is Gender and Financial Inclusion, this topic is specifically for you all. Let me start introducing this topic. We all know that there is two significant concepts today we are going to learn. One is the financial inclusion, second one is that financial exclusion. We will learn how to define financial inclusion, as well as if there is some of the population, if they have excluded from accessing financial institutions, what are the implications among those populations. So it is important to have a financial inclusion. Thus we will define what is financial inclusion, importance of financial inclusion, as well as at the end of this lecture I will also introduce few of the efforts taken by the Government of India through Reserve Bank of India to include all the population to access financial institutions. Let me start introducing the concept financial inclusion. When we talk about the financial inclusion is the availability of financial services at affordable and reasonable cost to sections of low income segments of society. If the population is if they belong to low economic background, it is important for them to access the financial institutions, specifically various financial products, to improve their status, specifically to improve their economic status in the society. Thus, if they could able to access various financial services provided by the government, certainly they could able to improve their economic aspects in their own life. Second significant aspects here we need to learn is that when we talk about the financial inclusion, specifically population, they have to get an unrestricted access to essential goods and services is the primary requirement in an open and efficient society. If any society is open and we think that particular society is very efficient, and if the particular society is performing economically very efficient, then all the population in that particular society, they need to have an unrestricted access to various financial products provided by the government. That is more important. Thus, the term financial inclusion has gained importance in the early 2000s. Now, everybody is discussing about the financial inclusion. It is a common objective for every central banks in every country specifically in the developing nations. All the central banks in the developing nations, they are working towards including all the population in their particular country to access various financial products. With this background, the learning objective of today's session is that two aspects today we are going to learn. First one is that we are going to look into the scope of financial inclusion in India. Second significant aspect today we are going to learn is to examine the factors affecting financial inclusions. These are the two aspects today we are going to learn. Apart from that, we will also come to know the certain efforts taken by the Central Bank of India to make every population to access various financial instruments in the country. Let me start providing rationale for financial inclusions. Immediately, all of us, what comes to our mind is that why do we increase financial products to all the population in the country? We all know that finance has come a long way since it was not recognized as a factor of growth and development in the initial period. The initial period, every countries, both developing and developed countries, they concentrated more on providing employment services or ensuring the food and other basic amenities for all the population. Over a period of time, the countries, they realized that it is important to, only in the year 2000 afterwards, the countries, they realized that it is important to include each and every population and make them to access various financial products provided by the bank and other financial institutions. Thus, it is now attributed as a brain of an economic system, and most economies strive to make their financial systems more efficient. Finance also keeps policymakers on their toes, as any problem in this sector could freeze the entire economy and even lead to contagion. Like the earlier research focused on how finance helps an economy. That is in the beginning itself I have mentioned that. Earlier, it is our government focuses on how finance helps to improve our economy. Now the research shows that financial inclusion is very essential. It is important for the countries to make each and every population of that particular country to access various financial products. The new avenue for research is finance is making financial inclusion workable in that particular country. I could give you one example. Patrick Hanohan from Trinity College, Dublin, developed an index to measure access to finance in 160 countries. If the index is put on a world map, these economies with higher indices are highly, like usually those we term developed or advanced economies. If you look at the developed and advanced economies, there each and every population in that particular country could be able to access various financial services provided by that country. It is not implied that financial inclusion alone has led to development. That is, we should not come to the conclusion that financial inclusion only helped the individual to became like they could able to develop economically and socially. It is not like that. Financial inclusion also one of the significant factors to develop an individual socially and economically. Thus, it is a very important factor. That is, we must understand that. The first question that comes to mind is why financial inclusion cannot happen independently. What is the reason that the government, specifically central banks, why do they take various measures to make the population to be part of the financially included? First, let me explain. Let us learn what is financial exclusion. Then we will understand the importance of financial inclusion. It has been found that the earlier research found that financial services are used only by the sections of the population. Very limited populations, they could able to access various financial services. Specifically, they could able to access the banks, and the banks also, they provide various financial services. Only very restricted population, only certain percentage of the population, they could able to access financial services. There is a demand for these services, but they have not been, they like financial institutions, they are not able to provide these services to everyone in the society. The excluded regions are, if you look at the, who are all excluded from the financial services are, mostly they are from rural, poor, those living in harsh climatic conditions where it is not easy to provide these financial services. The excluded population then has to rely on informal sector. Basically, if they are not able to access financial institution, certainly these people, they go to the money lenders to avail themselves to finance. Basically, the money lenders, they charge exorbitant rates, rates. Thus, most of the time, whoever access financial services from the money lenders, they may not be able to repay their loans. Thus, they were in a very critical situation. They are not able to improve themselves also. This is the situation. Like this leads to, like since they depend on the money lenders and for the exorbitant interest rates, most of the time they try to pay only the interest. They are not able to pay the principal amount. This became a vicious circle. First, the high cost of finance implies that the poor person has to earn much more than someone with access to low-cost finance. Second is that the central portion of the earnings is paid to the money lenders. If they earn a certain percentage, if they access to finance from the money lenders, they have to pay like large percentage of their earnings to the money lenders as an interest or to repay the principal amount. So thus that individual, it is impossible for the individual to escape from the poverty. Thus it became a vicious circle. That's why it is important to implement various measures to include each and every individual in that particular country to the formal financial institutions. Another significant issues here we need to understand is regarding high cost. It has also been seen that poor people living in urban areas also, not only in rural areas, poor living in urban areas do not utilize financial services as they find financial services costly and thus unaffordable. Hence, even in financial services is available, the high costs deter low-income people from accessing them. Like for example, to open an account in a particular country, specifically Cameroon, the minimum deposit requirement is over $700. If the person is earning less than that amount, it is not possible to open a simple savings account in a bank. If you look at this amount, that particular amount is higher than that country's average GDP per capita. In contrast, no minimum amounts are required in South Africa or Swaziland. Like another significant points here we need to understand is that annual fees to maintain a checking account exceed 25% of the GDP per capita in Sierra Leone, while there is no such fees in the Philippines. These are some of the examples we need to know that how the central banks and other formal financial institutions are operating in various countries. Thus, low-income groups are not able to access various financial services. For example, in Bangladesh, Pakistan and the Philippines, processing a small business loan requires more than a month. Well, the wait is only a day in Denmark. Denmark is a very developed European country. So, within a day, if you apply for a loan, immediately they will process it, that individual get the loan. Same time, if any individual wants to start a small business also in Bangladesh, Philippines, other few developing countries, they have to wait for a month to get their loan processed. Like that, the fees for transferring $250 internationally are $50 in Dominican Republic, but they only 30 cents in Belgium. This is the difference between how the financial products are given to their population in the developed countries, as well as how the financial products are given to their population in the developing nations. This is the difference between how the developing countries they are operating with regard to their financial institutions, as well as how the developed nations operating to provide the financial services to their populations. Another significant points here we need to know that non-price barriers. Access to formal financial services also requires documents of proof. Like the banks, they require various documents like person's identity and income. Most of the time, individuals from a low income group, they may not have income certificate. Thus, they are not able to access formal financial institutions. Like people experiencing poverty do not have this document, thus they are excluded from the services. They may also initially subscribe to the services, however, they may not use them as actively as others because of the high distance between the bank and residents and poor infrastructure facilities. These are some of the aspects. Another significant aspects with regard to financial exclusion is the behavioral aspects. Research in behavioral economics have shown that many people are uncomfortable using formal financial institutions. The reason are differently understanding language, various documents and conditions that come with financial services, among others. Let us now learn about the scope for financial inclusion in India. Why do we need to have a financial inclusion? As I have mentioned, the term financial inclusion needs to be interpreted in a relative dimension. Depending on the stage of the development, the degree of financial inclusion differs among countries. That's what we have learned, that some of the developing countries, they need various financial products to make the population to be financially included. Some developed nations, they need that much financial products to make their population to be part of the existing financial services, because already most of the population, they must be part of the existing financial services. It is now widely acknowledged that financial exclusion leads to non-accessibility, non-affordability and non-availability of financial products. Limited access to funds in an underdeveloped financial system restricts their availability to individual and leads to high cost credit from informal sources such as money lenders. Like due to lack of access to bank account and remittance facilities, the individual pays higher charges for basic financial transactions that we could able to experience from our personal experiences also. The absence of the bank account also leads to security threats and loss of interest by holding cash. All this impose a real cost on individual. Thus, there is importance to establish various financial services to the population in that particular country. Like prolonged and persistent deprivation of banking services to the large population segment leads to the decline in investment. It has a potential to fuel social tensions, causing social exclusions. Like if the particular percentage of the population, if they are not part of the existing financial institutions, they may be excluded socially also. Thus, financial inclusion is an explicit strategy for accelerated economic growth and is considered to be critical for achieving inclusive growth in the country. I hope that our learners, now you understood the significance of creating various financial products to make the population to be part of the financial services. Now let us learn about the need for inclusive growth. Like for example, pre-crisis growth, if there is a widening income gaps between rich and poor, urban and rural communities, that is the very important. Already we are in the neoliberal economic policies. Here, certain population is they growing and the income is they could able to accumulate the income. The existing studies clearly pointed out the widening gaps between rich and poor, urban and rural communities. Thus, there is a need to include these population in the existing financial services. We need to reduce income gaps and generally build social policies. That is important. Social policies can reduce precautionary savings and contribute to global rebalancing, as well as improved financial inclusion is very critical. Let us see the efforts of financial inclusion. If the government takes various efforts to include its population in the existing financial services, then the particular population could able to meet the credit needs of the able to meet their own credit needs, and they could able to access payment system and providing remittance facilities. All these efforts certainly lead to some notable developments that we could able to understand that. Now let me give you certain efforts taken by the central banks to make its population financially included. First one is that it started no-frills accounts. In November 2005, Reserve Bank of India asked the banks to offer basic banking no-frills accounts with the low or zero minimum balances and minimum charges to expand the outreach of such accounts to the low-income groups. That is the first efforts the Reserve Bank of India has taken. Second one is that easier credit facility. Banks were asked to introduce the general purpose credit card facility up to rupees 25,000. Then simpler know your customer norms, KYC norms, to ensure that people belonging to low-income groups, both in urban and rural areas, they should not encounter difficulties in opening bank accounts. Thus, there is a efforts to to minimize the know your customer procedure for opening accounts was simplified. For these accounts with the balances not exceeding rupees 50,000 and credits that too not exceeding 1 lakh in a year. Another significant efforts taken by the Reserve Bank of India is to use of information technology. Banks have been urged to scale up IT initiatives for financial inclusion while ensuring that solutions are highly secure, amenable to audit and follow widely accepted open standards to ensure eventual interoperability between different systems. Easily one could able to change their accounts from one bank to other bank. All those, thus the Reserve Bank asked all the nationalized banks to scale up their IT initiatives. Another significant efforts taken by the central bank is that electronic benefit transfer through banks. To encourage banks to adopt information and information communication technology solutions for enhancing their outreach, the Reserve Bank of India formulated a scheme to quicken the pace of adoption of the smart card based electronic benefit transfer mechanism by banks and rolled out the EBT system in the states that are ready to adopt the scheme. As per the scheme, RBI would reimburse the banks a part of the cost of opening an account with the biometric access or smart cards at the rate of rupees 50 per account, through which payment of social security benefits Mahatma Gandhi National Rural Employment Guarantee Act payments and payments under other governments. Now most governments are directly they are transferring cash to that individual accounts. Thus, the payments under other government benefit programs would be routed through persons belonging to below poverty line families. The scheme was first implemented in Andhra Pradesh. Another significant model established by the Government of India through Reserve Bank of India is that business correspondent model. The business correspondent model ensures the closer relationship between poor people and the organized financial system. In 2006, RBI reorganized this and permitted banks to use the services of non-governmental organizations, microfinancial institutions, retired bank employees, ex-servicemen, retired government employees, Section 25 companies and other civil society organizations as a business correspondents in providing financial and banking services, as well as the bank branch and ATM expansion was liberalized for making each and every individual to access various financial services. The Reserve Bank of India has totally freed ATM locations from prior authorization. Further, in October 2009, RBI took another big step by freeing branch openings in towns and villages with the population below 49,999. Then they could able to open a banks in various locations. If the particular population is really required the financial services, they are not able to access various financial services, the bank could able to open the either ATM facilities or they could able to small extension banks to provide financial services to that particular population. As well as there is another effort is that expansion of banks in the Northeast. To improve banking penetration in the Northeast, the Reserve Bank of India asked the state governments and banks to identify centers where full-fledged branches or those offering forex facilities, handling government business are meeting currency requirements. Another significant effort is that Project Financial Literacy. This project is regarding the stepping stone toward financial inclusion. Moreover, the need for financial literacy has become even more acute as financial markets became increasingly complex with serious information asymmetry problems. If you look at these various efforts, one could able to identify that the government also has taken various efforts to include various populations to be part of the existing financial services. Another significant efforts, we could able to see that these self-help group members also, they can form as a groups in the villages. Specifically, this self-help group concept has been expanded in various rural areas, specifically earlier in accessible areas. They could able to form the group, and if they could able to run the group for like 6 months, they can open an account in the nationalized banks, and regularly they could able to save, and they can access loan facilities for economic activities. I hope our learners could able to understand the significance of financial inclusion, as well as if the particular population is excluded from the financial services, and what are the implications for excluding from the financial services. Both the concepts I could able to explain in today's session. Thank you so much for listening this session. Happy learning. Thank you.